Welcome everybody to Safe Option Strategies presentation of technical analysis. This class is a production of Safe Option Strategies and the content is protected by copyright. Any reproduction or redistribution of this or any Safe Option Strategies presentation is strictly prohibited by law. The information presented in this class is for education purposes only. Safe Option Strategies does not make any recommendation to buy or sell stocks or options. Trading stocks and options comes with risk and you are solely responsible for any losses you may incur as a result of trading. So when we talk about technical analysis, we need to start the conversation by talking about why is technical chart reading important? What is the importance of patterns? You've heard it said many, many times, and you'll hear it many times going forward, and you've heard it from other people, and you'll hear it from me. What has happened in the past is never, ever a guarantee of what will happen in the future. That is simply a fact. The past performance on a stock, past indicators, past levels of support and resistance, we're going to talk about all of these coming up, but none of these things will ever guarantee what can or cannot happen going forward. It's simply not the way things work. But with that said, what has happened in the past is oftentimes the best indicator. That's why we call them technical indicators. It's oftentimes the best indicator of what could happen or what may be more likely to happen in the future. In other words, you've all heard this phrase or this this saying, "Fool me once, shame on me," or "Fool me once, shame on you; fool me twice, shame on me." The reason we use that phrase sometimes is to say, well, certain behaviors have a tendency to repeat themselves. If any of you have raised kids, or if you remember being a kid yourself, you know that you have a tendency to repeat certain things. When your kid does something enough times, you start to get a feel for what your kid is likely to do. You get to know them. Now, it doesn't guarantee they're going to do that, and that it's so important to remember that. As we go through and talk about the primary technical indicators that we use to try and predict the behavior of a stock going forward, the behavior of the markets going forward, it is so important that you always keep that tucked in the back of your mind, that you never let yourself forget that this does not guarantee what's going to happen in the future. But it is the best information we have. When we place trades, we are making educated guesses. Technical analysis is part of that education to help make our guesses better. What is the difference when, and this is a rhetorical question, you don't have to answer this, when you're talking to someone and you're talking about an educated guess versus some wild guess, don't you see those as a pretty big difference? I mean, hopefully in your mind, there is a big difference in your mind, hopefully, between a wild guess and an educated guess. If you go to Las Vegas and you're going to go black or red on the roulette table, that's just a guess. That's all it is. It's just a guess, 50-50. You might be right, you might be wrong. If, on the other hand, you're playing blackjack and you've got an ace and a king, and that's 20, and the dealer has a 6 and a 9, and you look at that situation and you say, okay, it is an educated guess based on this information that I have, based on the numbers of these cards. It is an educated guess that I've got a very high chance of winning. Now, could you still be wrong? Of course, you could still be wrong. What, the dealer could lay down a 4 and you're in trouble. But the odds are in your favor because you're making an educated guess. Now, I don't like to compare what we do in the market to gambling in a casino, but hopefully you get the point that we're making. We can make more educated guesses than not. We're still guessing in the market, and that's important to always remember. We're going to learn today, or we're going to talk about the RSI, the 5 and 20-day exponential moving averages, the MACD. We're going to talk about levels of support and resistance, and we're going to talk about the importance of volume. Now, in the next class following this one, when we get into more technical chart reading, we're going to take the first part of that class, and we're going to teach you how to set up your charts to look the way our charts look, unless you already like the way yours looks. So all of these charts that I'm going to show you, we're going to take some time, but we're going to do it in the next class to talk about how you can set your charts up. So be patient, we'll get to that. I want to give plenty of focus on these 5 indicators. I support and resistance, I'm considering one indicator, and RSI 5 and 20-day, exponential moving average, and MACD are 3 different indicators, even though I've got them on one bullet point. So there's 5 things here that we're going to cover in today's class. And then in the next class, whether you're watching it with us live tomorrow or whether you're just watching in order on the streaming classes, we're going to get into some other technical indicators, some other things to look at, how to set up your charts, etc. All right. The 3 big technical indicators are the relative strength index, a technical momentum indicator that compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an asset. We're going to talk about each one of these individually, so I'm going to go through these definitions quickly. 5 and 20-day exponential moving average, a type of moving average that is similar to a simple moving average, except that more weight is given to the latest data. The exponential moving average is also known as exponentially weighted moving average. MACD, moving average convergence divergence, a trend following momentum indicator that shows the relationship between 2 moving averages of prices. Now, is it really important that you know those definitions and could quote those to someone if they asked? No. In my opinion, I don't believe it is necessary to know these definitions. I do believe that you want to know what these 3 indicators mean and how to use them in conjunction with each other. And one of the main reasons it's important in my mind that you know these 3 indicators is a huge segment of traders and investors use these 3 indicators. Now, there are a lot of other indicators you can use. In the next class, one of the things we're going to talk about is paralysis by analysis. I've saved that for the next class. We're going to focus on these 3 big technicals and then the support and resistance and the volume level today. Before we do that, this is just kind of an FYI, and we'll talk a little bit more about this when we set up our charts, but I personally it's really for no other reason than how clean it looks and how easy it is to to me, it's eye candy, it's curb appeal. I like to use OHLC bars. When you see a stock chart, whether you're looking at a 6-month, a 3-month stock chart, whatever, an intraday stock chart, when you see these vertical up and down lines like this with the little hash marks, these little tiny tick marks that come off of these lines at different places, these are OHLC bars. The O is for open. The tick mark on the left side of each one of these vertical bars is for where the stock price opened. On this particular day, this price opened right around 32.50. This is as high as it got. The top end of this bar is the highest that stock traded that particular day. The bottom is the lowest the stock traded that particular day. And the close is the little hash mark that comes off to the right. So open, high, low, close. This is what if you ever hear someone refer to an OHLC bar, or if you've heard them talk about OHLC bars in the past, that's all it is. At a glance, I can see where the stock opened. I can see how high it was. I can see how low it was. I can see where it closed. If the vertical bar is black, it means that by the close of the market that day, the stock price finished higher than where it closed the day before. Regardless of where it opened, regardless of how high it was during the day, regardless of how low it was during the day. If it closes today at a higher price than what it closed yesterday, this will be black. If it closed today at a lower price than what it closed the day before, it will be red. That's all the black and the red mean. It's kind of the same with your volume indicators. We'll get into those in a little bit. So this is what an OHLC bar, where the stock opened, how high it got, how low it got, where it closed. A lot of people like to use candlesticks. There's a little more information available in candlesticks. I'm not going to discourage you from using candlesticks. I do not take the time in the Safe Option Strategies education to teach about candlesticks. I don't use them. I know what they're for. I know what they do. I know what they mean. I don't use them. They're not necessary, and not particularly the added information that you might get in a candlestick versus an OHLC bar is not necessary and relevant to the type of trading that we do. Doesn't mean it couldn't benefit you in terms of your overall educated guesses. I don't feel like it's necessary. So don't feel bad if you're using them and I'm not. Don't be afraid to use them when I'm not. But don't be disappointed if you don't see me using them. Okay, enough of that. Let's talk about the RSI, the Relative Strength Index. This indicates, so here you've got your OHLC bars down here. This is the Relative Strength Index up here. The Relative Strength Index has that dotted line that I just covered up with a solid line, which is the 50 mark. From here down, this is the price of the stock. This 10, 30, 50, 70, 90. So it's basically from here to here is our RSI. And when you have the RSI pulled up, you can usually see where it's at right today. So right here today, when we took this screenshot, it's at 83.62. What does it all mean? The main reason I look at the RSI is for crosses, technical crossovers above or below this 50 mark. It is considered a crossover. The RSI moving above this 70 line, you notice there's the dotted line at 50 right here, there's the solid line at 70, the solid line at 30. A move above the solid line at 70, a move above or below the solid line at 30, that is not considered by most people as a technical crossover. It is considered a move into or out of oversold or overbought territory. A crossover the 50 line, above or below, is considered a technical indicator for a move into bullish or bearish territory. Okay? Keep in mind the difference. We're looking at the RSI for two things. These crossovers into bullish or bearish territory, and then when you see this colored in, when you see this little shaded in area, I'll just add to it a little bit here. On the low side below 30, this is when a stock is considered by this momentum indicator, by this mathematic formula, the stock is considered oversold. It's just a mathematical formula that says once this has moved down below this 30 mark, and you see this shaded in right here, according to this indicator, people have oversold the stock a little bit. That may indicate that there is a good buying opportunity close by. On the upside, where this is shaded in, when it moves above 70, it's considered overbought. And what this for, and I don't know exactly, I'm not going to sit here and pretend to be an amazing mathematician and understand the algorithms that go into this, but this is an indicator that based on the mathematical algorithm here says that according to the history and the averages of what this company does, more people have bought it recently, and that's what's considered overbought. There's a higher number of shares that have been bought recently relative to what the average number of shares bought by the public is. That's what overbought means. Does overbought automatically mean that the stock is going to come back down? No, sometimes a company spends a lot of time in overbought territory. We use the RSI to help us figure out, is it oversold and should we be looking for a buying opportunity? Is it overbought and we should be looking for a selling opportunity or a time to protect it? And we look at it for these technical crossovers, a cross above or a cross below the 50 line. I'm going to talk more about those crossovers in a minute. Now, same OHLC bars up here. Down here below now, we have the moving average convergence divergence, the MACD. We look at the MACD. You heard the definition a few minutes ago. It's a momentum indicator. We use the MACD primarily when these lines, the two MACD lines, are just two price averages, and when they cross over each other, this would be considered a bullish crossover because they're crossing each other to the upside. This is considered a bearish crossover when when one of them crosses the other to the bearish side. Here's another bullish crossover. Here's another bearish crossover, another bullish crossover. Okay. When these lines begin to move from up to down, you know you're getting close to a crossover. As you can see right here, we're starting to tip a little bit to the downside. You may see this start to turn, and you may get a little bit closer to a crossover. Okay, we're looking primarily at these crossovers of the MACD to help us determine, is a stock looking like it's going to start moving bullish, or does it look like it's going to turn and maybe start moving bearish? We don't have to explain the formula. We don't have to know the algorithm or be able to explain the math behind it. We know that when we cross over, there's a greater chance that the stock is moving into a bullish or a bearish trend. Now, 5 and 20-day moving averages. Behind the OHLC bars, you can see this blue line. I'm coloring it over with red right here, sort of, if I can keep my cursor on it. And you see the red line. The blue line is the 5-day exponential moving average, and the red line is the 20-day exponential moving average. The difference between the exponential moving average and the simple moving average. Some people like to look at a simple moving average. I'm going to tell you right now why my preference is to look at the exponential moving average. If we take the last 5 days of trading and they look something like this, and let's go back even a little bit farther. Let's say this is what our last 10 days of trading looked like. The stock was moving down, and then it was moving back up. Okay? The 5-day moving average is going to take these last 5 days of trading, and where this line is today, I'm talking about the not the vertical, my mimicking of the OHLC bar, but the other line I'm drawing. Where that line is right now today is based on an average price of the stock over these last 5 days. In a simple day moving average, it's going to be these 5 days, the average price the stock traded in during those 5 days divided by 5. Simple moving average. Exponential moving average is going to put a little more weight on this day than this day. And it's going to put slightly more weight on this day than this day. And it's going to put slightly more weight on this day than this day. And the reason I prefer the exponential moving average is that when a stock has a gap like this, when a stock has a sudden move, it will pull this 5-day moving average up a little bit faster and create that technical crossover. If this was our 5-day moving average and this was our 20-day moving average, it pulls them up a little bit faster, and you get the technical indicator a little bit quicker. Then in a simple moving average, you don't see the crossover of the 5 and 20-day averages as fast as you'll see the crossover with the exponential moving average. Why is that important to our trading? We live in a very impatient world nowadays. That's not just with the stock market. That's with everything in our lives. We are an instant gratification society, and people don't like to wait for anything. And if we wait for the simple moving averages to cross over, we may miss the best part of this move right there that we could profit from, because that simple moving average took until here to come, and we saw it on the day it gapped up instead of seeing it a few days before. Now, that's just one example. But the simple moving averages will not cross each other as quickly as the exponential moving averages will, and that's the primary reason that I use the exponential moving average over the simple moving average, and that's why most investors and traders, a greater number of them, use the exponential moving averages more so than the simple moving averages. Here's some examples of where they're crossing over bullish and bearish. Now, when we set up our charts for our technical analysis to help us decide what we are going to do as far as our next move, we put all three together. We put our RSI up at the top. We put our 5 and 20-day moving average, our overlays, so they'll automatically be in the middle of the chart with our OHLC bars, and we put our MACD at the bottom. And here's how we use all three of them together. When we get all three of these indicators crossing over in the same direction at the same time, that increases the likelihood. Remember, I'm going to say it again. What's happened in the past is never a guarantee of what will happen in the future. But historically, more often than not, by about 75 to 25%, more often than not, when all three of these indicators cross over at the same time, we get a continued move in that direction for 2 weeks or more, or 2% or more, oftentimes both. This is a trend change. When the stock is trending down and we get a couple of days of upward movement, but none of our technical indicators cross each other, these 2 days are not a trend change. When our technical indicators cross and we get 2% or 2 weeks of movement in that direction, that is a trend change. Couple of days reversal on the price of the stock is not a trend change. Never forget that. Now, I want to talk about, for just a moment, I want to talk about crossing over at the same time. Anybody notice that not all three of these circles, we'll label these 1, 2, and 3. Anyone notice not all three of these circles are at the same time? The reason I put this vertical line in there is in part to show you that this crossed over ahead of this one and this one. It is not uncommon at all when speaking of these three technical indicators, it is not uncommon at all that the MACD is the indicator that leads the other two. Oftentimes, you'll find that the RSI and the 5 and 20-day moving average are crossing each other at the same time, or within a day of it. Very often, they're crossing at the same time. Oftentimes, the MACD, here's a case where they crossed over at the same time, but more often than not, the MACD is just a little bit ahead of the others. Not by far. Here's 3 times in a row where it was very, very close. But then here's another great example of where the RSI and the 5 and 20-day moving average crossed over together, but the MACD was well ahead of it. And it's not uncommon at all for the MACD to cross over earlier. And not to get it confused with a monthly economic report that comes out called the leading indicators report. That's different than the MACD being the leading indicator of these three technical indicators. Everybody okay on that? I should say, anybody not okay on that? So don't get it confused. Once in a while, you'll hear us talk about a financial report that gets released once each month called leading indicator report. Indicators in the economy of what direction it might be moving. The MACD is the leader of these three indicators oftentimes. Now, it's really important to remember that this is true of the MACD, but it's also true of the RSI and the 5 and 20-day moving averages. Once it's crossed over, we consider it crossed over until it has gone the other way. So even though the MACD crossed over, in this case, almost 2 full weeks before the other two indicators crossed, this is still all three happening at the same time, because until the MACD reverses, we have technically crossed over bullish right here. Let me repeat that and make sure you understand this. Until this reverses, we consider it crossing over bullish, and so we still can, once the RSI and the 5 and 20-day moving average catch up to this, we consider them all three crossed at the same time. Is anybody not okay with that? Okay? This is oftentimes a leader, but we still consider this moment in time, this vertical line, this moment in time is still considered the time when all three crossed over. How can we use okay, if you know, and now you know, if you know that the MACD can be a leader of these three indicators, how can you use that to your advantage? Okay. Simple. When the MACD changes directions, the MACD was bearish right here. Let me clean up my marks here, make this a little easier to see. The MACD was bearish right here. At this point in time, it crossed over bullish. This is a signal to me to pay closer attention to these two. Once that MACD has crossed over, I'm paying a little bit closer attention. If I'm managing 5 or 6 or 10 or 15 different open trades, and that can be a lot of work and that can be very time consuming. If I've got a trade going and all my position is set correctly when I'm in this bullish trend, I can kind of be on autopilot during this time. To a greater or lesser degree, I can glance at this at the close of each market day. I can take a peek at this, and if none of these indicators have changed, I probably don't need to do anything with my trade. Now, there's other things I may look at, and when we get into the individual strategies, we'll talk about that. But as soon as this crosses over, I'm paying a little bit closer attention each day. It's giving me a heads up. Look at the MACD as your heads up. Hey, I want to give you a heads up. I saw the boss from corporate headquarters had a flight itinerary to come visit our office at the end of this week. I just want to give you a heads up. Isn't it great if the boss is going to be in town and you're accustomed to the boss not being around and you can dress a little more casual and you know, have a couple more snacks on your desk, whatever the case is? Isn't it nice to have a heads up that the boss is coming into town? And it's good to just keep an eye on that. Think of it the same way. You've got a heads up now that something could be changing. That's how to use it to your advantage. All right. I left an older stock chart in here to illustrate this, but that's okay. Let's talk a little bit about support and resistance. What is a level of resistance? Does anybody know, would anybody here know how to define a level of resistance? Now, I purposely did not go on to any web pages like Investopedia or even Wikipedia for that matter. I purposely did not go on and pull in the definition of resistance because I want to give you my definition of a level of resistance and a level of support. And I want to explain support and resistance a little bit to you. What I've got drawn on the screen right now with this horizontal line is a level of resistance. When a stock is moving up and it hits a certain price point and pulls back, this creates a short-term resistance level. When the stock moves up to that level again and pulls back, this resistance level just became a little bit stronger. If we look back a little bit farther, we can see that even though it really briefly got above, it came back down really quickly. That makes this resistance level even stronger. If we see that it got up close to it and backed off, it's even stronger. The more times a stock price has come up and tested a certain price point only to back off of it, the stronger that level of resistance becomes. Think of your level of resistance as your ceiling. See if I can spell it here. Think of your level of resistance as a ceiling. That's where you're likely to stop. If you're going to try and move, people talk about the glass ceiling, breaking the glass ceiling. When people of different ethnic backgrounds got higher paying jobs, they had broken the glass ceiling. When Barack Obama became our president, he broke a glass ceiling. It's a level of resistance. It's a place where maybe others have tried and haven't been able to push through going to the upside. Okay? That's what a level of resistance is. Does it guarantee a stock will not go higher than that? Of course not. Stocks can go up and trade higher than that. It is simply an indicator that this is where, that the next time the stock is moving up, this is where it might slow down. This is where it might lose a little momentum. This is where it might have a hard time breaking through. Now, I want to teach you a little bit more than just what it is. Why is that the case? Why is that the case? What drives the price of the stock? Here's how I'm going to explain this to you. For those of you that are newer to this, here's how I want to explain support and resistance to you. For those of you who are new to this, what is it that drives the price of the stock? Buyers versus sellers. That's what drives the price of the stock. If there's a whole bunch of orders for selling the stock and only a handful of people, can a stock be sold if there's not a buyer? Okay, I know I'm backing way up to the most elementary of things, but bear with me and this will make sense. Can a stock be bought if there's not a seller? Can it be sold if there's not a buyer? Every single transaction that pushes the price of the stock higher or lower is based on someone selling the stock and someone buying the stock. You can't have stock exchange hands unless there's a buyer and a seller. The price of the stock will go up if there's a lot more people wanting to buy than people wanting to sell. That's good for the seller. That will drive the price up. If there's a lot more people wanting to sell than wanting to buy, the orders will get filled. The orders will definitely get filled, but the price may be driven down. Now think about this. Back here on these 2 or 3 trading days right here, after this nice strong bullish run up, were there still people buying the stock right here? Absolutely there were. There were still mutual funds buying the stock. There were still hedge fund managers buying the stock. There were individuals like you and me buying that stock. And then what happens right here when it's going down? Well, some of those people are bailing out. Some of them are bailing out, but some are not. Some got into that stock and they're saying, man, if I sell it, I book a loss. Huge, huge difference. Never forget this. There is a huge difference between being drawn down on the value of a stock and actually selling it and booking the loss. You haven't lost anything until you sell the stock for less than what you bought it for. So when the price is going down, a lot of the people that bought right up here are still holding it. And they suffer and they agonize and they sweat it out. And finally, there's a little bit of relief when it starts to come back up. And then they worry a little bit when this happens and a little more relief when it comes back up and a little bit of worry when this happens. And guess what happens when it gets right up here where they bought? They say, holy smokes, man, I'm getting out. I'm not going to live through this again. I'm getting out now. And guess what? Volume of selling increases. The number of sellers, all those people that suffered through this time period right here are saying, they're breathing a sigh of relief now. Whew, I bought at 54 in the final days of that bullish run 4 months ago. I bought at 54. Man, the second that thing touches 54, I've given my broker instructions to get me the heck out of that thing without a loss. And it's no wonder it pulls back a little bit. And then it can do it again and again. Now flip now there's medium-term resistance. Now flip all of that on its head, and support is just the opposite thing. When a company has a breakthrough resistance, look, after all this time, we've got a 1-year chart on here and a little bit of a test right here, a strong test right here where it kind of got over but fell back down. A test of resistance right here, a test of resistance right here. And finally, on a phenomenal earnings report, on an amazing earnings report that skyrocketed this thing up, it broke through. And oftentimes, prior resistance matches up pretty close, maybe not exact, but pretty close with new support. So think of support as the floor. We said that resistance was the ceiling. Think of support as the floor. Sometimes you're going to jump up and down on that thing several times before it breaks through and goes down. People see this level right here and they say, stock skyrocketed up. little bit of profit taking came, and then it kind of moved back up. So if it moves down to this level again, that may be a really time to buy, a really good time to buy. Last time it was at this level, it had a nice run up. So now that it comes back to this level, I may decide to buy right here because that worked out really well for the last people that bought there. And this becomes a level of support. And doesn't it make sense? If you know that people were buying back here and finally they had a chance to get break even right here, it makes more sense why it takes a little bit to get past that level of resistance. And when people think of this price as a new bargain basement great price, it's no wonder that the stock might bounce off of this a couple of times. And that's what support and resistance are. And that's what drives support and resistance. Now, you've got near-term support and resistance, the most recent time that these levels were tested. You've got longer-term support and resistance. Here's some near-term support. There's support in the previous 3 months to the time this screenshot was taken. Here's the longer term support. There was a little bit of support tested here. There was a little bit of support tested here. There was a brief test of support right here. Here's the nearer term resistance. So you've got near and long term resistance. Now, how do we use near and long-term resistance? I'm introducing it right here for people that are newer to trading and newer to technical analysis, but I will tell you this. When we start looking at trades, when we start looking at actual strategies we could place, when we start looking at our 3 technical indicators, and we look at a chart and we say, wow, this might be a really good time to put on a bull call spread, wouldn't it be nice to look back here and say, now, I've got a level of resistance based on these moves back here. I've got a level of resistance right here somewhere around $54 a share. When I'm looking at everything, when I'm looking at the whole equation, I'm looking at the company, I'm looking at earnings reports, I'm looking at volume, I'm looking at all this different stuff, and I think, I want a bull call spread. It's good to know where is the next place that this stock may slow down a little bit. And is this room from here where I'm getting in to right here? And when we're looking down here, we haven't seen any of this information out here. None of this has happened yet when we're looking at it on this trading day. But we look back here at this level of resistance and we say, can I make enough money if the stock moves from here to here? Because probably there's at least a good chance that that's where it will slow down a little bit. And lo and behold, it did. We might be looking at a bearish trade on these technical indicators right here. And we might say, you know, I'm barely, let me clean this up to make more sense of this. We might be looking at a bearish trade because right here, we got our 3 technical indicators. There's the RSI, there's the 5 and 20-day moving average, and a week and a half, 2 weeks ahead, the MACD. But we had a little test of support right here, and that's awfully close to prior resistance, which oftentimes becomes new support. And can I make enough money in that little move down right there? Maybe not. Maybe this scares me away from the trade because of what that level of support might be. That's how we use support and resistance. I am going to caution you right now, do not rely solely on support and resistance levels to place your trades. You've got to use it in conjunction with these other technical indicators that we were talking about. Now let's talk a little bit about volume and then we'll wrap up. This chart down here, this section down here at the bottom, shows the volume that traded on the stock. Now, when you can see maybe on your screen, depending on how good the resolution is on your screen, you can see that these are either red or green. And when we were talking about the OHLC bars and we said a black bar simply means that the price of the stock finished on this particular day higher than it finished on the day before, it's the same thing with these volume spikes or any of this volume. The red days are simply indicating that by the end of that day, the stock had sold more than there were more sell orders than buy orders. Now, there has to be sell orders and buy orders to fill, but a lot of sell orders may have gone unfilled and the price of the stock may have been driven down a little bit. When we look at this volume indicator, we're looking at our average daily volume, and then we're looking for these spikes in volume. A spike in volume simply means that if it accompanied technical crossovers, there is a greater chance of a deeper or a farther move or a continued move in that direction. It's not an absolute guarantee that things will continue. Here was a volume spike, and then the stock stayed pretty flat for about 4 full weeks after. So a volume spike, here was a volume spike, and very shortly after, the stock bottomed out and went back the other direction. A volume spike by itself is no guarantee. It can still be an indicator, but it's no guarantee of what's going to happen. When you get a volume spike with your other 3 technical indicators, you simply are increasing the chances that you get a farther move in that direction. Okay? There's a lot more we're going to get to with technical analysis and technical indicators. We're going to get into more in the next class. I want you to remember, no technical indicator is perfect. We use the RSI. Remember earlier I said that a large percentage of investors use the RSI, the 5 and 20-day moving average, and the MACD. They have the ability to be self-fulfilling prophecies. I'm going to back up the screen for just a moment. I want to show you one more thing here. One of the main reasons we use the RSI, the 5 and 20-day moving average, exponential, and the MACD is that a lot of investors are just like you and I. They're waiting for these 3 things to happen at the same time or very close together, and then they make their move. And if a lot of people are waiting for that, it increases the chances that the move is more than 2% or more than just a couple of weeks, because it becomes a self-fulfilling prophecy. A self-fulfilling prophecy is when you tell people so many times over and over again that it's going to rain, that when it finally rains, you look like a genius, if they forget about all the days it didn't rain in between. When we actually see this happen, then a lot of people move. Oh yeah, Jeffrey said when this happened, we should sell. And a lot of people do that. And then the sell-off gets bigger and it gains more momentum and it lasts longer. Jeffrey and 3 other people that I sometimes listen to said that when this and this and this all come close to the same time, it's a good time to buy. Well, if a lot of people suddenly buy, it pushes everything up farther. They have that tendency to be a self-fulfilling prophecy. And until that changes, those are going to be the first 3 technical indicators we look at and use, because that's what most of the market is doing. And so it more often than not bears fruit. We want to pay attention to support and resistance, and we want to pay attention to volume, but I want you to be careful. We'll talk about this a little bit with all the different trades we do. Don't rely solely on those indicators. I know a couple of people who have lost a lot of money when they forgot about technical crossovers and started adjusting everything strictly on levels of support and resistance. And it caught up with them quickly and it burned them to the tune of big losses. Okay, a lot more to get to. I hope you're able to either join us in the next class that we do live that will expand on a lot of this, or if you're just watching the streaming classes, you go to the next one in order, and we'll teach you a little bit more about technical charting and technical analysis. Thanks, everyone. Bye-bye.